Good morning, good afternoon, good evening, or good night, depending on where you're joining us from. This is Alex Craigie with the Coalition for Green Capital, and I wanted to welcome you to the Green Bank Network webinar series. My name is Alex, as I said, and today we're very lucky to be joined by friends from Michigan Saves and the Montgomery County Green Bank. Our guests will be talking about their financing programs in support of the clean energy in commercial and industrial buildings in their target markets. We're going to hear about how these innovative finance programs were designed, how they've evolved over time, and how to overcome key challenges when designing an effective green bank financing program. We're really glad to have two of the most innovative and creative leaders in the U.S. green bank space join us and share their wisdom and counsel. Also, I want to note that today's webinar is part of the Green Bank Network webinar series. Check out the Green Bank Network website for more details on upcoming webinars. Before we kick off today's webinar, I'd like to do a little bit of housekeeping. All attendees are in listen-only mode, so please type any and all questions that you have into the question window in your GoToWebinar interface. Please type in your questions at any time during the presentation, and we will save them until the end, and I will be your voice and ask them on your behalf. Before we get started, I'd love to do a brief introduction to our speakers. I'll start with myself. As I said, this is Alex Craigie. I'm a program director with the Coalition for Green Capital. I've worked on green bank development and creation around the United States, and I'm currently working on the creation of a green bank consortium which will serve U.S. green banks. I've been closely involved with the creation of the Connecticut Green Bank, the Montgomery County Green Bank, and I'm now working on helping to start up the Nevada Clean Energy Fund, Nevada's soon-to-be green bank. We're also lucky to be joined by Mary Templeton, who's the president and CEO of Michigan Saves, a multi-million-dollar nonprofit organization that just passed $100 million in total financing made available. So congratulations, Mary, on that recent milestone. Michigan Saves provides financing solutions for energy efficiency and renewable energy improvements. In this capacity, Mary designs financing programs, oversees organizational governance issues, operations, fundraising, marketing, HR, technology, and programmatic strategies. And she's responsible for the fiscal management of the organization. Prior to Michigan Saves, Mary's career spanned more than 20 years in several industries and included roles such as Executive Vice President of Sales and Marketing with Wind Energy Consulting and Contracting, Senior Vice President of OEM Sales for R.L. Polk, and several leadership roles with the SAS Institute. Our second speaker is going to be Tom Deo, who is the CEO of the Montgomery County, Maryland Green Bank. Tom brings his finance, operations, and mission-strong background to accelerate MCGB's goal of bringing greater access to clean energy and energy efficiency financing for households, businesses, and institutions in Montgomery County, Maryland. Tom has over 30 years of experience in the for-profit and nonprofit sectors in financing and investment, technical assistance, knowledge building, and grant making in housing and community development and green programs. Tom has worked at the national level with financial services institutions and nonprofit intermediaries. His work has delivered products and services to local civic and nonprofit organizations with a focus on their low and moderate income constituents. With that brief introduction, we'll turn it over to our first speaker, Mary Templeton of Michigan Saves. Mary, the mic is yours.
Thanks, Alex. I appreciate it. I'm delighted to have the opportunity to be a part of the Green Bank Network webinar series, and happy to share our story. My intention and my hope is that through sharing our story, you all can learn from some of our successes and our challenges along the way. as Alex mentioned, we are a nonprofit green bank. Our footprint is the state of Michigan. Next slide, please. We started, just a little bit of background on when we started. We started back in 2009 with a grant from the Michigan Public Service Commission, and our intention at that time was to help. There was some new energy legislation that was just passed, and there was a great recognition that in order for people to do energy efficiency work, they needed to have a way to finance it. And that was 2008, 2009, and it was hard for people to get money to finance things like energy efficiency. So the Michigan Public Service Commission awarded us a grant to begin to research what an organization, a green banking type organization, might look like. We ended up setting it up as a nonprofit, independent nonprofit, and we did that because we did a lot of stakeholder feedback. We engaged all kinds of people into discussions about what was needed to fill gaps in the marketplace. So we interacted with contractors and customers, lenders, nonprofits, entities that were serving the market, governmental units, and we asked everyone what works, what doesn't work, where are the gaps in the marketplace. And we ended up with a structure that is comprised of us operating as the program managers, the organization that brings all of these entities together. What we heard when we were doing the stakeholder feedback was that there were plenty of contractors that were able to do the work. Customers didn't really know a lot about energy efficiency in Michigan at the time, but there were plenty of lenders who wanted to provide capital for energy efficiency improvements. They just weren't doing it in a way that really served the marketplace. So in other words, they were not offering lending options that were specific to energy efficiency work or renewable energy work. Their terms were very short, their processes were very long, and so our intention was to help really streamline the lenders' processes. The structure that we used is we created, through the grant for the Michigan Public Service Commission, and then later from the Department of Energy, we got some additional funds. We created a credit enhancement in the form of a loan loss reserve that basically protects our lenders in case of default. And what that allowed our lenders to do was to offer better rates, better terms, and approve more applicants so that we could really encourage energy efficiency work. Next slide, please. Since we started in 2000, and actually our first loan was issued in 2010, we now serve the residential market, the commercial market, the municipal market, multifamily, and like Alex said, we just surpassed $100 million in energy efficiency and renewable energy financing. We're actually up to about 140 right now. And what I'm going to focus on this afternoon is the business energy financing program, which serves the commercial and the industrial customers. And I'm going to take you through the last, 8 years, 7, 8 years, and talk about these years in phases. And you can see from this slide that we started out very, very slowly. I'll go into each of these, so you'll see this information later on, and I'll get into more detail as we go. But I'll break it down into the early years, kind of the middle years, and then the years that we're in right now. And I'll talk about what strategies we used in each of these, what our challenges were, and how we worked to overcome those challenges. Next slide, please. So let me focus on the first 3 years. We had some funding from the Department of Energy that focused us in one city. It was the city of Detroit. It was 2010 to 2013. So economically, not a great time to be focusing on asking people to spend money. We also were focusing in the food service industry. What we ended up doing was working with a local community development financial institution lender. So this was a local lender. They only served the city of Detroit. And at that time, they were not really familiar with energy efficiency lending, and they asked us to create a loan loss reserve structure that was a 50% loss reserve. You'll see the evolution of the loss reserve as I go through the slides. This initial 50% we think is super, super generous. We reduced that over time, but they were just really not clear about whether people would default or not. And so they asked us to set aside for every single loan that was issued 50% of that into a portfolio. And then when or if someone defaulted on that loan, we would pay up to 100% of that default up to the portfolio, the 50% of their loan portfolio. We were also offering interest rate buy downs up to, they have 1.99%. And then we offered free audits. Next slide, please. We've faced a lot of challenges. Like I said, economically, it wasn't really a great time for people to be spending money. The small businesses really, and especially in the food industry, the owners who would be making the decisions were busy running their stores, their grocery stores, their restaurants, trying to make it work, trying to really survive the recession at that time. And energy efficiency just was not at all forefront in their mind. So what we saw was that people weren't going to replace their equipment unless it broke. And our lenders process really, really lengthy. They asked for all of their financials. The business owners couldn't even get at their finance. They couldn't even take the time really to get a financial package together to be able to present it to the lender. And so we had very few applicants. We had nobody really knew us, and there were very few contractors. Next slide, please. So what did we do? We had a lot of challenges. We weren't making much progress. The first 2 years, we got one loan a year, so pretty pathetic results. And so we said, well, my goodness, we need to do something different. So we ended up developing marketing partnerships with people that served the city of Detroit who specialized in the food service. And they really helped us knock down some of the barriers to entry. They helped us get in the door so that we could start talking to these, the business owners. And then we also identified a couple of really active contractors who could work with us to do those audits, to help evaluate what the customer needed. And we offered pretty aggressive financial incentives. I mentioned that we offered 1.99%. We also offered rebates on any work that was done. I think we offered up to like 50% of the project being done just to really get that market going. Next slide, please. So you can see from these numbers that, like I mentioned, the first 2 years, one loan in the first year, I think that loan was $35,000. Another loan in the second year, that loan was $110,000. By the third year, which is 2012 here, we were up to 5 loans, which still really pathetic results. It was $245,000 portfolio. I'm going to talk about the year 2013 in just a minute, but you can see the jump. I wanted to leave this in here so you could see the jump from the 2012 results to the 2013. And why don't we just go to the next slide? The differences between 2012 and 2013 is that we were able to open the program up to serve the entire state. So we weren't limited to the Detroit's footprint. We did have really aggressive interest rates. They were starting at 5%, but we did buy, through the grant, we were able to buy down those interest rates to 1.99%. We also were able to, we ended up working with a different lender who was able to serve the entire state. And because of, we just got better at negotiating, and we thought the original loss reserve of 50% was really too aggressive, we were able to reduce that to 25%. So we launched our statewide program. This is pretty consistent to what we currently offer. Terms 2 to 5 years, the amounts as low as $2,000 and up to $250,000. Next slide, please. some of the challenges, what I did on this slide is I left the challenges that were mentioned in the initial pilot on the slide, but I'm starting to cross out some of the things that are being resolved. So you can see on this, we're still facing a lot of challenges on a statewide level, but with this new lender, our process was really, really streamlined. We have a one-page application. You don't even need financials if it's less than $150,000. So we're starting to get the interest from the contractors where they're not feeling like they have to do an enormous amount of work in order to use the loan product. Next slide, please. That financier was an equipment finance lender, and the reason that they were able to offer really streamlined processes is that's the business they were in. They weren't necessarily doing energy efficiency financing, but they were doing all kinds of other, like they would did all other types of equipment financing. So it was a process that they knew, and we looked for that when we issued our RFP to find the lender. We looked for somebody who was going to make it really, really easy on our contractors, because that's exactly what our contractors told us they needed. Something really streamlined, easy to work with, able to be approved within a matter of minutes, so that when they're in that business's boardroom or meeting with a business owner, they're able to close the deal right then and there. We were also able to use some of our early work to create some really great case studies that we ended up giving to our contractors and distributing at various trade shows, events, industry groups, and associations. Next slide, please. So you'll see that we were able to go from our measly little 2012 5 projects financed to, in 2013, we're starting to run a little bit more volume through. We had 71 loans in 2013 for a value of $1.6 million. And then in 2014, we're continuing to grow. We're continuing to kind of grow our presence within the state. We're able to issue 108 loans at $4.6 million. So, like I said, we're expanding statewide. This is a time now when that initial grant has closed. So our 1.99 incentives are no longer, interest rate incentives, buy downs are no longer available. There's no longer a focus on the food service industry. We're focusing on every single industry. Next slide, please. And we enter into the next phase of being able to serve every single commercial entity within the state. We end up bringing on another lender to offer another kind of competitive way to offer these loans. And to be quite honest, and I think this is really useful for people who are in the Green Bank network, one of the reasons that we decided to add another lender to our portfolio is just to make sure that we were getting the best rates and terms available. And we wanted to make sure that our customers were benefiting from the most competitive rates and terms that were available in the marketplace. And so I think bringing that extra lender on helped us to keep our lenders really honest. We were also able to, with the addition of the new lender, be able to once again reduce our loss reserve to 10%. And we've now even in, I think, 2017, we've brought that back. We've brought that down even further to a total portfolio loss reserve of 5%. Next slide, please. The other thing that we introduced at this point in time was interest rates in partnership with our utility energy efficiency program. They've started to buy down our interest rates to 0% for small projects. And you can see where some of the challenges now, they're starting to really be reduced. There are still some, right? Small businesses still have pretty limited resources, and there are several contractors, not only a few, that offer comprehensive services, but all of these other things are starting to be checked off the list. And one of the reasons that energy efficiency is becoming a priority now not only when it breaks, is in large part due to what we've done with some of these incentives. And so next slide, please. We've been able to get competitive rates and terms. Our loss reserve is allowing us to approve like 85 to 90% of the projects. So the expanded underwriting is a real win for us. We've got a great network now. We've got a very easy process and very minimal paperwork from the contractor side, which is what they tell us all day long. We do charge a small contractor fee to pay for our operations. That fee is 1.99% of anything that's financed. Next slide, please. So you can see with these incentives, this approach, us kind of learning about how to work with the contractor network to really get the word out. We're starting to see good increases every year. We're moving from 2014 to 2015, we doubled to go from 108 to 218 loans, 2016 then to 277, and 2017 to 315. And in 2017, we had a $10 million year, which we were super excited about. We're hoping to even increase that further in the future. Next slide, please. Some of the lessons learned for us, the interest rates really helped those small businesses to make it and help the contractors convince the small businesses that they didn't have to spend their own money basically to make these energy efficiency improvements. So they made it really easy for the customers to say yes. Ease for the contractors and customers was absolutely essential for us. The strong contractor network was really an important piece. And then our utility partners and other partners were really helpful in juicing those incentives so that it made it really easy for our customers to make the decision to do energy efficiency work. Next slide, please. And we continuously listen to our contractors, our customers, our utility partners, and we're continuing to adapt our program as we go forward to serve the market even more pervasively. What we're doing now is we do have a pretty aggressive goal to grow to finance $1 billion in energy and energy efficiency, renewable energy by the year 2023. That's an all market. But what we've realized is that there are some additional gaps in the commercial and industrial market that we think that we can serve pretty effectively. We do have a commercial PACE program that runs in our state. We don't administer that program, but we know that our loans were going up to $250,000. There's a gap between $250,000 and $1 million at a minimum that PACE really serves well. And we think that extending the terms to be a little bit longer than the 5 years that we started out with to get 7 to 10 year terms for those larger project sizes will fill a void in the marketplace. So we've just launched a partnership with HBC Energy Capital to introduce them as a lender to serve that market. We'll continue to use interest rate buy downs as much as we possibly can, as long as the funding is available. And one of the things that I think is really interesting about the introduction of this new lender who's got those longer terms, still really good rates, is that the loss reserve is not even required with this new lender. So we've gone from a 50% loss reserve to the introduction of this lender with no loss reserve whatsoever. I'm going to stop there, and Alex, I will turn it back over to you.
Great, thank you, Mary. And thanks for a great presentation as always. A reminder, we're saving audience questions till the end, so please continue to type any questions that you have into the question window. We appreciate the ones we've already received, and we'll ask them during the discussion at the end of this webinar. Now we're going to hear from Tom Deo, who's the CEO of the Montgomery County Green Bank. Over to you, Tom.
Good. Thank you, Alex. Can you hear me? Just make sure I'm on.
You're good.
Good. Thank you. All right. And thank you, Mary. I appreciate that presentation and lead-in. So, hello, I'm Tom Dale. I'm the CEO of the Montgomery County Green Bank. So, I'm going to walk through a presentation here which pretty much gives you a feel for how the maturity of the Green Bank effort across the country here has helped to launch a local green bank, which we are, the Montgomery County, Maryland Green Bank. And I'm going to kind of cover two topics. One, just a quick sort of review of what it might take to set up a local green bank for those who might be sort of interested in that. And then to sort of move into sort of how we've sort of moved to get our first product out. And it was important, I think, as we launched to sort of think through how do we get in the market quickly. And so we were able to accomplish that and give you a sense of how we were able to do that. But if we go to the next slide. So just in high-level overview, we're the Montgomery County Green Bank, and we're your local partner for clean energy. We are the nation's first county-level green bank, and we were chartered by the county in 2015 and then established in 2016. We're sort of what we call a government-sponsored enterprise, but even though we were sponsored by the county, we are set up as an independent 501c3 nonprofit. Only 2 of the 11-member boards come from the county, and that's important in terms of structure because it does give us a chance to sort of relate to the county, given our name, and get benefits from that, but also having that independence allows us to be flexible and fluid and move a little bit more as a private market would expect an enterprise to move. We were capitalized with $14 million of funding from the county based on a merger between 2 utilities, and the county, in its wisdom, felt that as they got that merger funds, that they felt that they should think of the way to leverage them versus sort of seeing it as a rebate program. And so that's why they came upon the idea of a green bank as the enterprise to invest that money in and find a way to partner with the local lending community and grow that by a multiple. And looking at Mary's slides there as she sort of spaced out between her early years, mid years, and current years, I would say by number of years we are really in our early years, but by virtue of having a mature green bank network out there and partners out there like Michigan Saves and getting a lot of benefit from the learnings they had, I'd say we probably are in our middle years of maturity and not having to sort of spend those early years learning and benefiting from Mary's learnings there. So on to the next slide. So just a couple things to just, if you're thinking about a green bank, I thought I'd start with just some things to think about as challenges or needs of standing up a green bank. First is the opportunity to get some capital. The capital is an essential sort of component to the green bank. With it, then, as you can begin to build partnerships and begin to take some positions you need in order to bring other capital into the market. But some form of capital is important. You need a certain infrastructure of operational infrastructure to sort of to build upon, and I think the benefit of a green bank network being mature out there does bring some ability to sort of tap into some of that expertise out there. Sustainability is an important thing. You have to determine whether you're looking to be a sustainable operation. Mary mentioned getting some of those fees in order to support their operations, and so thinking about, is that a structure and a strategy that your particular green bank needs to operate under. And then the challenge around market assumptions. I think a lot of utility incentive programs out there and so forth kind of drive people to think about green banks as being another subsidy source, and I think it's important to define yourself upfront importantly about, you're a financer and investor and not necessarily a subsidy provider. And so sort of get ahead of the branding and communication there. And then the last is needing models in order to sort of build upon and execute a plan around. And again, the maturity of the network does bring an opportunity to sort of look at models that are out there and try to bring them in. So while these represent challenges, I think they all the fact that the market exists, the green bank network exists, allows you to sort of move through those expeditiously. So on the next slide, the last thing I just want to talk to before I get into the product work we're doing is just some initial lessons learned about being a local green bank. One is, don't be afraid of being local. There's a few things that I think are positives. One is, everything is local. Tip O'Neill said politics are all local, and it certainly turns out that most enterprises all have a local nature to them. And by being local, you have a much closer tapping into what the market needs are and understanding what the specific local energy issues are and financing and other resources in the community. And being local allows you to have very face-to-face opportunities to create partnerships. And you can very much align yourself with whatever local goals are. So there's a strong benefit of sort of being identified as being local and being part of the community. The second is being local is not about being alone. And as I was mentioning about the Green Bank having a network out there, it certainly allows you to feel like while you're focused in a local way about what your products are, you have very much a national sort of ability to tap into resources, be a part of a knowledge exchange, get some peer mentoring along the way. So you sit locally, but you can think and work in a national way. And then lastly is scale. And scale is an important component to sort of drive sustainability and to drive results. But scale at a local level also has many other dimensions, such as the connections you can make in the marketplace and help people connect ideas of energy efficiency renewable that may not have a presence there otherwise. You have the ability to talk about the multiple number of partnerships you're able to create in order to grow the influence in the market. And often you can be scale on voice, where there might not be a unified voice talking about what's needed in the market in energy and renewables. And so there's another level of scale. So I'll end there with the idea of about the larger nature of the Green Bank and move on now to more local ones. So go to the next slide. So so the first thing I just wanted to sort of talk through is, Mary talked about the product that she had in place, and, having Mary's experience out there and her being a very available and friendly party to sort of helping us think through things allowed us to sort of find a model that may be of use. But I think the idea of a model is it sits there and it has all its components to it, but you need to think about, okay, how do I then bring that in locally? And early on, we kind of lit on the idea that we needed to go commercial and industrial first in order to get a sort of, get quick to market on something. And it was a defined market. It was well sort of identified by the contractor core out there and other incentives. So we sort of went there first. But the first thing that we undertook was another level of due diligence in the market, getting really an understanding from the utilities, the contractors, the lenders, really what was going on. And there was a good part of that, which was sort of relationship building, right? You get people together, you get them in focus groups, they begin to understand who you are, they begin to give their sort of ideas of what you should have. And through that sort of market due diligence, we really did get to some of the key terms that were going to be important for us to work on as we developed the product. It also identified where there were dead ends, such as one of the key terms was that it should be an unsecured loan when you go to the market, that if you do a secured loan, you're likely going to be dead in the water with the commercial property owners who don't need another lien on their property. So that market due diligence really did identify some key terms. You move from that to the product framing, you look at the model. Some of the key things that we looked at was what's the operational burden on this for our organization. We're only going to be, 2 people likely, and therefore we needed to sort of think through how do we manage our operations and the burden on it. We also, being a new entity, wanted to assure quality control was out there. And it helped us think through, how do we sort of talk to our lenders. So it did really give us an idea around, narrowing, the methods we would do and how we would approach it and what marketing we needed to do. So from that, we built out a product and marketing package, and we used that to go talk to the lender market that we had originally talked to in a due diligence manner. And what it really did, begin to show the real interest and that there was really going to be a product in the market and begin to build the sort of lender interest in it, because now there was a reality. It just wasn't sort of a theoretical conversation. That sort of exercise also of going back to the lenders and contractors developed a certain collaborative approach to it that they then bought into, as we weren't out there just being sort of sole on our own, that we were actually looking for partners in this. So it began to develop a stronger set of back and forth and trusting relationships. We took that feedback, we turned it into some product revisions, and when we did that, we brought it back out. And I think there, the lenders and the contractors began to say, okay, you are asking us for input, we're responding, we're seeing that. Okay, we can begin to feel like, okay, you're building something that's going to be valuable to us and meet our needs. So we got through that period, and then we went to closing. And with any closing, it always takes a lot longer than you think it's going to take. And this did take some more time. You do have some fallout that happens during that, but it also, in doing that and being out there in the market, we actually got some additional interest as well. So closing takes more time, but it also sort of builds more interest. And then the next sort of last lesson learned is that once you close and you have a product, it doesn't stop. And Mary talked about that, about having to develop marketing strategies and really get the product out there. And that's presently where we are. And so it doesn't stop at the launch. That's actually just the beginning of the end of that period. And you move into the sort of really active role of trying to build a pipeline, build more relationships. So next lesson. So next slide. So what did that mean? So the product that we developed, what we learned. Could you go to the next slide? There. So the first product, what we did was what we learned was that there was a gap out there that existed between the county had a PACE program and they had a small business program, but what they didn't have was something that financed well between $25,000 and $250,000. The utilities really offered, their benefits to the low end market and not to the larger. And so, there was a need for financing there because there was a gap after the incentives. And we found out that the lenders really, were not in the marketplace for doing something tailored to energy efficiency renewable. They just had their sort of standard commercial business product. And so there really wasn't something that could be immediately tapped into. We went to a design stage and we saw the Michigan Saves model and we felt the loss reserve would be a benefit there and that would be attractive to the lenders and we would tie it to a scope of energy efficiency renewables. We felt that having no property lien was going to be key to customer interest. And before we went live, we went back and tested it with the contracts who were going to be the sort of marketing aim and they felt that it met the test as they saw it. So the product ended up again, leveraging much off of the Michigan Saves in terms of structure, but it's 100% financing that a borrower can take. It's an unsecured loan. It's just going to be secured with a UCC filing on the fixtures, but not to the property. We were able to get a loan that was going to go out to 12 years, and that would allow for matching the energy savings that would come from the scope of work installed against and allow for a neutral to a positive cash flow benefit to the business owner. It was only going to be a credit underwriting. I think this is what Mary's experience showed. Rather than looking at underwriting that energy savings, really underwrite the borrower and therefore not have to worry about the lender trying to sort of get through the machinations of trying to figure out is the energy savings real or not. And then we instituted a quality control review in order to assure that there was some outcome. If you go to the next slide, this gives a little bit of feel for structurally how it looks. So, there's sort of three parties on the outside and then us on the behind, right? So our relationship is with the lender. We stand behind the lender with a loan loss reserve. And we leveraged heavily Mary's experience and we went straight to a 5% loan loss reserve, and as opposed to going from the 50 to the 25 to the 10 to the 5, we went straight to where Mary was able to say it was valuable. And we went to a 5% loss reserve, and we share with the lender on an 80-20 basis. If they have a loss, they can claim 80% of that. And we're basically doing a 5% of the total portfolio is what we're guaranteeing, or we're putting a reserve behind. So we stand behind the lender. We have authorized contractors, so they agree to participate in the program. They're all part of the utility programs, commercial programs, so we assure that there's a quality level of contractor. They're interacting with the customers. They're coming up with the scope of work, and we require that they target a 15% energy savings from current conditions to when they get to completion, so we know the energy savings is going on. The loan that we provide can only be to energy efficiency or renewable scopes. The relationship is the lender and the borrower. The lender's doing all the underwriting on their credit and not on the energy savings. And then we're kind of providing that higher level oversight. So this is the program we launched. We've got 2 lenders that are in the market right now with the product that are offering it. We're in a pilot stage, and then we've got 6 contractors that have been approved for the program. We launched it in just this last March. So go to the next slide. I think that one. So this talks about where the product is, right? We got 2 lenders, a local bank, Revere Bank, which brought new capital that they hadn't been in the market with before, and Continuum Capital is a national lender that was already participating in Michigan Saves and wanted to expand in the market. So as as an entity bringing in more capital into the market is what we were able to do by bringing both the Revere Bank, adding some of its own capital to the market, and Ascentium being a brand new lender bringing their capital. The property types are only commercial buildings and businesses, although that does include multifamily properties, which is important in the local marketplace to serve that constituency as well. Limited scope of energy to energy efficiency, although we do allow 30% of the loan to be outside of energy efficiency or renewables, and they can include the things like water conservation or other improvements that need to take place at the same time as the other energy efficiency improvements. And our quality control was really around the contractors and making sure that they were part of the PEPCO program. I already went through the terms, so I won't go back through that. So if we go to the next slide. So just some last sort of observations of the keys to getting our product launched. It was really that outreach and relationship building at the front end that really, I think, paved the path to getting to a launch. We got a lot of insight from the partners. We built relationships. We went back early and repeatedly to them so that we kept them in the loop and kept sort of building those relationships, and they began to understand what the Montgomery County Green Bank was really about. The network, as Michigan Saves, Connecticut Green Bank, Coalition for Green Capital, all were incredibly important in terms of giving us wisdom, examples, and materials to learn from and adapt. And so that was important for speed to market. There was an alignment that was also sort of important. We would talk to a number of different lenders, but early on, trying to figure out who was sort of really working and thinking about being a part of this. And aligning with where their interests were. Revere Bank had a very strong interest in being in the energy efficiency green and being labeled that, and that was hugely important to them, and therefore we sort of found an alignment and an allegiance that we got with that. And then lastly is patience, but importantly, setting some aggressive timeline. Keep it in mind, be flexible about having to amend it, but if you have that aggressive timeline and keep it highly focused, and can get you to market. So you set it, you be patient with it, but don't lose sight of it. And then the last thing I just want to mention, go to the last slide here. Next slide, yeah, is this kind of goes back to, okay, now, we got a product launched, but being a part of the Green Bank network also brings other resources to it as well. And as you think about, how a product fits in your market and you sort of explore where the gap is, there's ways to fill it with many different approaches, right? So county had a commercial PACE program, really served 250,000 and above. That was important to know it existed. We didn't want to sort of take over that program or bump up. So we created our program on the lower end of 250,000 and less in order to sort of serve underneath that program. But we also recognize there could be some very large-scale programs out there, and the Green Bank Consortium that Alex mentioned, is developing other opportunities and resources that could come online maybe down the road. And when they do, that becomes another avenue of bringing resources into the local community. So as a local Green Bank, I don't have to necessarily sit there and I've got to solve every equation on my own terms, but I can solve some on my terms, recognize what's there already in the county, but also think that these other resources that may be created at a national level that serve the consortium of green banks can be brought in locally and serve the local market. So being a local green bank has an opportunity to bring in resources beyond all that sits on its balance sheet by tapping this broader network. So that was where I was ending. Appreciate the time, and Alex, I'm going to turn it back to you.
Thanks a lot, Tom. And thanks to both of you, Tom and Mary, for your excellent presentations. We have a few questions that come in from the audience. We'll turn to those first. I have some burning questions of my own that hopefully we can get answered. But to those of you who are still on the line, please do continue to type your questions into the question box, and we'll ask them of our presenters. So the first question is coming from Bettina Burgu at the NRDC. Can Mary talk a bit more about how Michigan Saves and its lender partners originates projects? What have been some of the more successful demand generation techniques? Why not yeah, we can just start right there, Mary.
Okay. Yes, there are several ways to approach the market in terms of generating demand. I would say if I had to choose one, I would choose the contractor network. These are the people that are out there selling their products, selling energy efficiency to the business owner. And that has been a really effective way for us to get the message out. So we spend a lot of our time educating the contractor network, building the contractor network, educating them of not only about what our loan offers, also about other products that may be complementary to what it is that they're offering that really drive energy efficiency or renewable energy. And we work to kind of teach them a little bit about what we've learned about how to position the financing when they're going into a business to try to sell them a deal. The other thing is our utility trade allies have been absolutely essential in helping get us exposure to that contractor network.
Great, thank you, Mary. That's very helpful. Tom, we know you have to jump off in just a bit, but would you mind digging in? This might be in a little bit more of a nascent phase for you, but what has worked so far when it comes to demand generation techniques?
So,
Tom, are you there?
Yeah. Sorry, I just took it off mute. Yeah, so I agree with Mary on the contractor side. I think that's a very important one. They're the ones that are sitting sort of in the face of the potential customers out there, and so we're trying to make sure that we're giving them all of the materials and that they can use to get in there. The other is we're trying to get in front of audience, these sort of demand audiences, right? We're going with the Chamber of Commerce's, we're going to the Rotary Clubs, we're trying to get in front of the Apartment Owners Association, and in Montgomery County there's a huge sort of association of the HOAs and condos, and trying to get in front of them. So trying to sort of find ways into that sort of demand side as well, and trying to get them to understand we exist and the products that are available. We're also, really much trying to target and use the county resources and their apparatus for communication. And they interestingly are doing a benchmarking sort of exercise, and it's been at the very large buildings, but there's going to be now 50,000 square foot and larger is now just coming on in the fall. And I think that will offer an opportunity to sort of look at where are the property opportunities out there, and then have a little bit more of a direct marketing campaign to them. So we're looking at, one, working with the contractors who have that sort of direct connection, but second, trying to see ways to sort of get in front of the demander audience.
Great, thanks, Tom. And Tom, one more for you very quickly before you have to run. This one's a dandy. Did you have to get special permission from the banking commissioner or other regulator to use bank in your name?
Alex, yes, Alex, you know this one well. In fact, yes, we did have to. We did struggle with that. We put our name in for approval at the DLLR, and the initial response was, well, but you're not a bank, and you have bank in your name. They did do their own research, though, and began to see that Green Bank was a name in use in the marketplace with the Connecticut Green Bank and the New York Green Bank. And they said, okay, so if you have Green Bank, that does mean something different. And as part of the negotiation to approve our name, we had to have that tagline, your clean energy partner, as part of every time we do present ourselves. And so we were able to get it through, but with that extra. I will say that the Green Bank is a good thing in order to sort of identify yourself with the network. Even when you speak about it locally, though, you still have to explain yourself locally that you are the bank, even though it says Clean Energy Partner. Your partners still have to understand what role you fit as well. So, Alex?
Thanks, Tom.
Yep. Okay.
I did. And so I can speak a little bit more to this as well. What we've run into throughout the Green Bank movement's history There always is some degree of scrutiny that comes with using the name bank. It's really up to the local partner if it's worth the trouble of going through to have the name. As Tom said, it's a valuable tool. What we're doing in Nevada right now is we're creating a Nevada Clean Energy Fund, which is a lot easier. Yeah, that's an individual decision. Now, we'll move on to the next question here. Mary, we got some questions during your presentation about why didn't, on your initial terms of your loan, the 5-year terms, why didn't you look for longer-term loans that are usually more in line with energy projects? And was there any particular reason to limit the size of the project to $250,000?
Yes. So the terms of the loan, so size of the loan and the terms kind of in my mind go hand in hand. You know, like if you've got a $100,000 project, many times businesses don't want to finance that for very long terms. So let me start with the size of the loan. We intentionally decided to go small because our research showed that that was a market that was underserved. It was those small businesses that were not able to get the financing that some of the larger businesses could get. In addition, commercial PACE is available in our state. And even though it really doesn't make sense from my standpoint to incur the fees or the complexity of PACE for anything less than like $750,000 or $100,000, they were starting out in the marketplace at, $300,000, $400,000. So with both of those two factors, it really made sense to fill the gap of those smaller businesses and the smaller projects. The question about term, so like I said, if it's kind of a small dollar amount, you're not going to finance for a long period of time. And to be really honest, at that point in time, so this is 2010, 11, 12, the lenders that we were reaching out to had no interest in going beyond that. They were really hesitant to extend the financing beyond 5 years. They said, commercial entities are used to 5 years, 60-month terms, and we don't want to take on the risk of going beyond that.
Great, thank you, Mary. We've got another one for you if you're willing to take it.
Sure.
How did Michigan Saves convince the utility to fund the interest rate buy-down program? How did you twist arms on that?
The utilities were pretty eager, and here's why. They, through the legislation, they have energy waste reduction goals, and they continuously look at how their rebates and their incentives are affecting the market and whether they're serving all of the various markets that they are intending to serve. And when we came to them, we talked about what markets were not going as well as they had expected them to go. And that, once again, that small business market, it was really hard for them to get the small business owners' attention. And they were doing really well in some energy efficiency process improvements in the industrial side. And, the people that were spending millions of dollars on energy efficiency improvements and getting lots of money in rebates, but those small transactional work and energy efficiency improvements were not going as quickly as they would have liked it to go. And so we talked to them about interest rate buy downs, and they started out pretty small, but every year they've increased their budget to fund those, and they're still seeing that it is cost effective to offer the incentive and the interest rate buy down. So they're happy to do that to really encourage those small businesses and those smaller transactions to move forward.
Great, thank you, Mary. A question was asked toward Tom, but I know he's probably scuttled off to get ready for his board meeting at 1, which was a gutsy move of him to join a webinar right before, but hats off to him. The question is, PACE already existed in Montgomery County. Can we speak to how the Montgomery County Green Bank talked to PACE administrators to ensure that it wasn't going to encroach on their turf? And I can say, having worked with hand in glove with Tom during the creation of the CLEAR program, it's really a feel thing. And generally what you need to do is engage with local lenders that are participating in the PACE program, find out what their floor is. You know, Mary mentioned $1 million. We've heard 300,000 was kind of a magic number in Montgomery County. So there's a lot of room for discovery in there. It's about what people who are participating in the PACE program feel is just not worth the transaction costs. At what level of loan volume is it not worth the transaction costs? So that's when you're gathering information from market participants during the research for setting up the program. That's when you start to figure out where it hurts. You know, where the level is that folks don't want to touch if it goes below. So that hopefully that answers that question. Mary, I think we have time for one more quick one for you, and I just want to say thanks to everyone on the webinar for such an engaged presentation here. Really happy to see all these questions come in. I want to go back to Mary, what you touched on with this new area that you're focusing on below PACE, the below 1 million, you say. How did you figure out that besides in just conversations with lenders, how did you diagnose this sub-PACE space as a place that you wanted to be in and was good for you as an organization and also for lenders and business owners in the community?
Right. So I think that this is really complementary, Alex, to what you just talked about when you talked about talking to lenders and to contractors about where kind of the pain points are. As our statewide commercial PACE program started to get a lot of traction, we work very closely with them. We present on panels all the time. We actually have a joint contractor network. And so we interact with them and the business owners that are either applying for a PACE or for Michigan Saves. And so I'll just give you an example. Our commercial PACE program, they're really, really good about referring people to us that don't meet some of the requirements of PACE. So as they refer, and we'll do the same thing if there's a project that's too big for us to cover or that really needs a longer term to be able to be cash flow positive, and that's really important to them, we'll refer them to PACE. And so through that referral network and also through conversations with the contractor, we're able to talk to those business owners and say, okay, what doesn't work for you, right? Like, where is it that you need financing? And they have told us that the 5-year term is just too low. It's too short. They want their investment to be cash flow positive. 20 years might be a little bit too long. They don't want the complexities of a PACE or that, it's just too costly. So they wanted something that kind of fit in the middle of it. We're still testing that, but we do think that that's a market that is underserved where it makes sense to spend some time and attention.
Great. Thanks, Mary. Well, the clock just struck 1, and I want to thank everybody for their time and attention again. I especially want to thank our panelists, Mary and Tom. Thank you guys. Tom, I'll pass this on to Tom in another venue. But thanks so much for great presentations and some really great questions from the audience. As a reminder, this webinar recording is going to be posted on the Green Bank Network website, so please check back for that. And to keep up to date on upcoming webinars and events, be sure to sign up for the Green Bank newsletter, the Green Bank Network newsletter, and follow us on Twitter. With that, thanks again, Tom and Mary, and have a great day, everybody. Thanks for joining us.